California's housing market just recorded a 15% spike in foreclosure filings, and in Riverside County alone, active listings have surged by over 30%. That's not a slowdown, it's a stress fracture. So here's the question: is this the perfect storm or the next big trap? You know what they say, cash is king when the market crashes. And if you're waiting for the bottom, you may already be too late. In this video, I'll walk you through the numbers the institutions are watching, reveal where distressed assets are quietly changing hands, and show you how high net worth investors are positioning for the next recovery wave. Stay with me, because in just a few minutes, you'll know exactly which California cities are primed for double-digit rental yields in 2025. Let's start with what's happening right now on the ground in California. Across the state, home prices are softening. According to CoreLogic, California's median home price sits at $786,400 as of Q1 2025, down from $819,000 a year earlier. But that number doesn't tell the whole story, because when you break it down by region, the divergence is striking. Look at this chart. Median price declines. Inland Empire versus Bay Area, 2024 to 2025. And you'll see a classic tale of two markets. In the Inland Empire, encompassing Riverside and San Bernardino counties, prices have slipped by over 7% year over year, landing around $510,000. Meanwhile, in San Francisco, the median price remains above $1.2 million, but it's still down 5% from last year's peak. Now, what's causing this uneven collapse? Three main forces: rising foreclosures, deteriorating affordability, and a widening inventory gap. Foreclosures across the state are up 15%, according to Atom. That's 22,000 filings in Q1 2025 alone. But Riverside County stands out with a staggering 25% jump, over 3,500 filings, the highest in the state. And consider this: foreclosure filings by region, California Q1 2025. The concentration of distress in the Inland Empire is creating exactly the kind of pressure that smart capital looks for. Meanwhile, affordability has hit a historic low. The National Association of Realtors reports that California's affordability index is now at 16, which means just 16% of households can afford a median-priced home under current mortgage rates. And with the Fed holding at 4.5 to 5%, we're still seeing mortgage rates around 6.7%. That's locking out retail buyers and opening the door for cash investors. From what I've seen tracking this market since the post-COVID spike in 2021, we're entering a classic liquidity inversion. Sellers want yesterday's prices, but buyers, with capital, are setting today's terms. And this is especially visible in inventory trends. Look at this chart. Active listing surge. Riverside versus San Francisco, Q1 2025. And the imbalance jumps off the page. Riverside County now has over 12,000 active listings, up more than 30% year over year. In contrast, San Francisco has just 3.9 months of supply, up from 2.5 a year ago, but still relatively constrained. You know how this works. When inventory builds and affordability drops, prices follow. But here's what investors often overlook. Not all markets correct equally. Inland areas get hit harder, faster, and recover sooner. That's where the edge lies. Let's talk strategy. If I were deploying $1 to $3 million in capital right now, I'd start in Riverside and San Bernardino. Why? Because these counties are seeing a surge in REO listings, bank-owned properties, often discounted 15 to 25% from peak prices. You can pick up duplexes and fourplexes in the $400,000 range, and rents haven't dropped. In fact, Redfin reports rental yields in the Inland Empire at 6.5% compared to just 4% in the Bay Area. And look at this chart. Rental yield comparison, Inland Empire versus Bay Area, Q1 2025, to see how income-driven investors are shifting their focus. For US-based investors, this is the perfect time to execute a 1031 exchange. Roll over gains from higher-valued assets into distressed income-generating real estate and defer capital gains. For UK, Canadian, and Australian buyers, these properties sit well below prime metro pricing in your home markets. A $510,000 investment is about 390,000 British pounds or 690,000 Canadian dollars, a compelling value compared to inner London, Toronto, or Sydney. But here's the key: move before institutions move en masse. BlackRock, for example, acquired 15% of California's distressed multifamily inventory in 2024, according to Vanguard reports. They're not done. And neither is Starwood Capital, which committed $800 million to buy 1,000 units across the Inland Empire, most at 20% discounts to 2022 pricing. You don't need Starwood's balance sheet to play this game. One of my private clients, an investor out of Melbourne, recently acquired a 12-unit riverside property for $1.9 million, all cash. It was fully leased within 45 days, generating a net yield above 6.7%. His edge? He closed in under 2 weeks, beating institutional buyers still stuck in due diligence. Later in this video, I'll show you which inland cities are showing the best ratios of price to rent and where inventory spikes are just starting to push distressed listings onto the market. But let's not overlook the Bay Area entirely. San Francisco, Oakland, and San Jose are still overpriced, yes. But they're also seeing a soft reset, not a full crash. Zillow notes that high-rise condos in Oakland have dropped 5% since Q4 2024, with forecasts showing a possible 7% additional decline by Q3 2025. For patient investors, that's a trigger point. And remember, cash is king in a crash. Bay Area sellers are price-anchored, but they're also weary. Retail buyers are sidelined by 6.7% mortgages. That means when panic sets in, or when unemployment ticks above 5%, we'll see sharper price drops. Watch this carefully. Price decline projections. Bay Area condos 2024 to Q3 2025, and you'll see the window forming. If you're planning to strike in the Bay Area, you need two things: liquidity and speed. Focus on sub 1.5 million assets, especially multifamily, and be ready to close fast. And for international investors, consider forming a US LLC or REIT structure to sidestep withholding via FIRPTA, especially if you plan to sell within 5 years. Here's another angle: migration. According to Zillow, the net outflow from San Francisco to the Inland Empire has slowed significantly, meaning that oversupply is now hitting both ends of the migration corridor. This kind of compression tends to amplify volatility in prices. And consider this: migration reversal trends. Bay Area to Inland Empire 2021 to 2025. It's a leading indicator that demand will not catch up to inventory until prices fall further or mortgage rates ease. So where's the smart capital going? Right now, it's focused on distress with yield, not growth with risk. That means Riverside, San Bernardino, and in some cases, Sacramento. These markets are offering cap rates north of 6%, even on stabilized assets with downside protection baked in. But I want you to think even bigger. Because later in this cycle, around the third quarter of 2025, we may see institutional withdrawal from over-leveraged portfolios. That opens the door to bulk acquisitions, small packages of 5 to 10 properties from distressed owners, banks, or even failed funds. I'll show you how to spot those deals and position yourself for them, right after we review the rental growth trends and which submarkets are showing resilience. And before we wrap up, I want to leave you with one last strategy that's proving highly effective for seasoned investors in 2025, even in this declining market. We're seeing more activity around portfolio-based acquisitions, where small landlords, overwhelmed by rising rates and vacancies, are quietly listing bundles of 3 to 5 properties at steep discounts. These off-market deals rarely hit Zillow or Redfin, but if you have the capital and the speed, this is your moment to step in and consolidate high-yield assets before institutional buyers catch wind. Take a look at this chart: housing inventory versus buyer demand, California 2024 to 2025. And you'll see exactly why this timing matters. Inventory is climbing. Buyer demand is stagnating. But that gap won't last forever. Once rates dip, or even if they simply stop climbing, we'll see a resurgence in demand, and prices will start to firm up quickly. From what I've personally seen working with investors in places like Riverside, Sacramento, and Oakland, the ones who acted early, who didn't wait for perfect conditions, are the ones locking in 6 to 8% yields today, while everyone else is still running numbers and waiting for clarity. So let's recap a few of the key takeaways from today. First, foreclosures are rising, but that also means serious opportunities for investors who know how to navigate distress. Second, institutional players are already positioning, and that tells you everything about where this market is heading. Third, if you're buying in California right now, focus on regions like the Inland Empire, where discounts are deeper and rental yields stronger. Fourth, use your speed and liquidity as leverage. These are your greatest advantages against institutional buyers. And fifth, build tax strategy into your acquisitions. Whether it's a 1031 exchange for U.S. investors or planning around FIRPTA, CGT, or SDLT for cross-border buyers, the right structure can make or break your returns. Look, waiting might feel safer, but in this market, waiting too long can cost you more than acting early and wisely. Acting now means locking in yield, negotiating better terms, and building a position before prices start their next climb. And once that happens, the competition will be fierce. So let me ask you, which California housing market do you think holds the strongest upside in 2025? Are you ready to buy, or are you still waiting it out? Drop your thoughts in the comments. I read every single one. And if you don't want to miss the next wave of profitable real estate opportunities, hit that subscribe button now. Like this video if you found it valuable, and share it with anyone serious about strategic investing in California real estate. At EstateScope, we're here to give you clarity, data, and strategy, without the fluff. See you in the next video.